My name is Nathan Mercereau, President of Planning Alternatives. Welcome to Outlook 2016. This is our webinar where we present our perspective on what happened in the past in 2015, thoughts about 2016, and how we can navigate what's going on in the financial markets, in financial planning strategies, and really give you clear insight into things that are relevant to you. We welcome you. Thank you for taking your time, the time out of your schedule today to be with us. We know that we have a wide range of people in our audience, and we appreciate everyone spending time with us. Some of you are at different stages of life, whether it's getting ready for retirement, whether it's in retirement, whether it's at an accumulation stage. Many are at different levels of wealth, and that's okay. We want to present educational resources using this webinar so that you can really gather information that's relevant to you, and then when we meet with you on an individual basis, we take that information and make sure it's clearly applied to your situation. So we look forward to having future discussions with you as a follow-up to this webinar. Now, there's a quick overview that is brought to you by our compliance department, and it's simply to say that this is an educational session, and we also ask for any feedback that you have during the process. You'll notice on your screen that there's a box which allows you to submit questions. And as we go through the webinar and you hear something, please feel free to submit a question through that online box. And at the end of the webinar, we're going to have a question and answer session. Now today, we have a great group of people ready to share insight. And you can see them, all of us on your screen. Bill Vanover, Christy Geisens, Jim Nazinski, Nicole Gapoyan, and Jason Close. We don't have Marilyn Dimitrov and Ed Shaw today, who were in our Outlook presentation last month, but we've got a great panel of experts, and I know that you're going to get a lot of value out of the time you're spending today. The format is going to be hopefully unique, and I, Nathan, am going to pretend that I'm you, a client or a prospective client, and I'll act as a moderator, but I'm going to be posing some questions to our distinguished panel of experts here, and hopefully those questions are questions that are on your mind, things that you've been noodling and would like to get some clarity on. As we got together here as a team, we wanted to create this format to bring value to you in our commentary, and hopefully we're on the mark with some of the questions and discussion points. So the format is I'm going to be talking about and asking questions about what happened in 2015, what happened or what's going on in 2016, and what are some planning strategies as well as investing strategies that we need to consider as we continue into the year. So I'm going to switch my hat to client mode, and I'm going to say hello, panel of experts. I've got a lot.
Hello, Nathan.
Hello, Bill. I've got a lot of questions for you, and the first one is a suggestion. I think you should have renamed this Look Out 2016, not Outlook 2016, because it has just been a crazy start to the year with the financial markets gyrating and things going up and down. So I've got a lot of questions, but Bill, I know you're a good history guy and have great insight. I remember talking to you in the past when we did this last year. I kind of want to look at 2015, and as I was looking at my reports and my portfolio, I was not excited. I didn't really make any money. I didn't make any money. And did we miss the boat? Was there something that we really should have been focused on more so I could have made some more money? What happened in 2015, Bill?
Well, good afternoon, Nathan, and to everybody. Nathan, in 2015, no, you did not miss the boat. In fact, there weren't any boats really that left the dock. If you look at the number of asset classes that we have up on this chart, you can see that on the left, domestic stocks, and on the right, bonds barely eked out a 0.5% return in either case. And the other three asset classes that we're showing, which are international stocks, alternative assets, think coal, oil, copper, all of them down big, in some cases very big. And alternative strategies were down 2.5%. So in the scheme of things, from looking at the beginning of the year to the end of the year, there just wasn't a great opportunity to be had in 2015. But all in all, not terrible as compared to some years. And if you look at the next slide, you'll see that we have a diversified portfolio of stocks, bonds, and alternative strategies, with about half in stocks, about a third in bonds, and 15% in alternative strategies. And really the goal of diversification is to make sure that you benefit from the long-term upward bias of the stock market over time, and yet you don't have the total volatility that goes along with the stock market by introducing bonds and other asset classes. The next slide shows you 8 different asset classes from 2005 to 2015. The key to each of the asset classes is down below. Each has a different color, and you can see by looking at this chart, the first thing is that returns are very random, both in an absolute and relative basis. There are times when a certain asset class has a good run for a period of time, but the best return on this decade was around 79% by emerging markets in 2009, but it was preceded by a 53% decline the year before. So the lesson from this slide really is that a moderate mix of all of these asset classes, as illustrated by the silver cells that are to be found in the center of the chart, really give you a smoother ride, but again with an upward bias in terms of rates of return. On the next chart, you'll see that during the course of 2012, 2013, and 2014, large cap stocks did return pretty good numbers. And so you could be forgiven if, when you opened your statement in January, you had a sense of disappointment after a good run for those 3 years. But on the next slide, you'll see that when you have returns over a long period of time, in this case we show 36 years, and out of those 36 years, 27 of them were positive. But nevertheless, regardless of whether you had positive years or you had negative years, in every year you had a drawdown, as illustrated by the red dots on the bottom half of the chart. And as a matter of fact, the average inter-year drop was 14%. So volatility does come part and parcel with the stock market, but again, we're looking to take advantage of that long-term upward bias of the market. Then on the next slide, you can see a close-up of how returns and volatility have fallen out over the course of the last 6 years, with a drawdown back in 29 of 28% it showed. And you can see that in 2015 there was a drawdown of 12, but we ended up with a -1. So again, to sum it up, Nathan, there was no boat that left the dock in 2015, but we didn't do bad.
Okay, so what my takeaways are is that just that, what you said about not missing a clear type of investment, but that the diversification thing, I remember that quilt chart that you keep showing me every time I come in the office, and I always need to be reminded of that. That shows you that you got to mix things up, and you try to stay in the middle of the investment returns, not the highest or the lowest, and I'm okay with that. Okay.
Absolutely. You don't want to make a killing necessarily if you can avoid being killed.
Okay, good. Well, I'm more concerned about 2016, and oh my goodness, this has been Maalox, Tums, whatever you got. I turn the TV news on and I see all these headlines, and I I'm so stressed out about 2016, you don't even know. So, Jay, I need some perspective. What's going on, and how should we really start to think about the world in 2016 and beyond?
Okay, great. Thanks, Nathan. Well, let me start by saying, I guess to your point about the volatility in the beginning of the year, that markets are uncontrollable. They don't want to be told what to do, and it's tempting to think that we can corral them with forecasts, but they're going to choose their own path as they have in the early part of 2016. But part of our outlook is to expect surprises, both positive and negative, along the way in the coming years. I want to share our thoughts on three components, and we're going to cover the economy, we'll cover stocks and bonds. And in the following slides, you'll notice circles like those at the bottom of this screen. They indicate our read on the economy, on stocks, and on bonds, along with a few supporting data points. When you see green, that indicates a positive trend, white is neutral, and red is negative. So let's jump right into it in terms of the economy as a whole, and we're really talking about the domestic U.S. economy. Our outlook is neutral for U.S. economic growth. We think we're about midway through an economic expansion, and we expect to see a continued trend of slow but positive growth. And let's look at some supporting data points. The first one is leading economic indicators, and this is a composite of data points with a decent track record of anticipating trends in growth. The reading or trend here is neutral. The chart shows data going back to the early 90s, and the dips mark the last three recessions. When recent data on this chart is climbing and above that dotted line, it points to an expanding economy. And you can see the data has turned over a little bit, but it's still above the line, and that points to a modest expansion. The next slide we'll look at inflation. This is the year-over-year change in the price of goods and services. The trend here is positive, and we're looking back to the shows back to the 60s inflation, and we can see that inflation is pretty low. And what low inflation will deliver is lower interest rates. And lower interest rates removes a common headwind for economic growth, and that's why that reading is positive. Next slide. We'll look at unemployment. The percentage of people who want a job but can't get one. The trend here is positive, and this chart shows the broadest measure of unemployment back to 2000. And you can see that spike during the financial crisis. But since then, we've seen a labor market that's been steadily improving. And we continue to see strength in monthly releases. And what's important to remember here is that about 70% of our economy is tied to consumer spending. So it's critical that we have a strong labor market to see sustained economic growth. Next slide. The price of oil made its way into Bill's comments, and no doubt is in every newspaper that you've seen over the last few months. The price of oil is down to about $30 a barrel off its 2014 peak of above $100. The implications of this trend, in our opinion, is neutral. On one side, the U.S. consumes about 19 million barrels of oil a day, and about half of that is consumed in the form of gasoline that goes into our cars, and that leads to a little bit extra money for us to spend, and that's a positive for the economy. On the other hand, lower oil prices have hurt the energy sector, which had been growing and investing and creating jobs. All of that has come to a screeching halt, so that's a negative implication. So to us, it's a toss-up. Which ends up having a greater impact remains to be seen, and that's why to us this is a neutral trend.
Okay, so I'm seeing in the economy that there's some good things, but you're pretty much in the middle with how you see things. So you call it neutral, and I understand that. What about stocks? Like, there's been so much gyration going on in the stock market. What's your take on stocks?
Yeah, stocks, the engine of the portfolio. Typically, they're there to drive growth over the long term, as Bill mentioned. They've been on a great run since 2009. From here, our outlook is neutral. It's not negative, and of course, in any year, as Bill pointed to, we expect volatility. We're living through one of those moments, and it's always uncomfortable and somewhat nauseating, but that's part of our expectation. Now, going forward, we expect to see returns below long-term historical averages. and closer to mid-single-digit returns. And we can look at some supporting points here. The first is simply stock prices. And we're looking at the S&P 500 back to the mid-90s. To us, this trend is neutral. It points to the fact that prices move in cycles. And this is actually a pretty extreme example in that we're showing two of the worst periods in history, in the dot-com bubble in 2001, 2001, and 2002, and then also the financial crisis in 2008. So if you're looking at this and asked to complete the picture in some sort of behavioral exercise, you might project a collapse. That's not what we're hoping to communicate through this. In fact, we wouldn't be surprised to see the market recover and go on to make new highs for a few more years. But in the end, we know that trees don't grow to the sky, stocks won't climb forever, and all economic expansions ultimately end in recessions. That's the nature of the cycle. It's impossible to know exactly when that will happen, however. The next slide, though, if we look at some supporting points, what items are driving stock prices, we're looking at corporate earnings for U.S. large cap stocks, the S&P 500. To us, the trend here is neutral. Again, earnings are driving stock prices. In this chart, general earnings for the S&P 500 back to 2004 shows earnings falling off as you'd expect during the financial crisis, and during the recovery, a steady march higher until we see a earnings plateau that's largely explained by weakness in energy and material stocks. But going forward, we need to see this number tick up. We need to see stronger revenue and stronger earnings growth to see sustainable advances in stock prices. The next slide shows a combination of the first and second components of our stock discussion, the price and the earnings, in a ratio format. The trend here is neutral. What we've seen over the last few years, since 2011 through 2014, is a market willing to pay more and more for earnings. They bid up the price, the markets bid up the stocks in anticipation of more and more growth in the market. We don't expect that trend to continue, and in fact, of course, during the early part of this year, we've seen the trend reverse some. So that, to us, is no longer a source of expected return in stocks, and we simply need to see earnings turn higher to advance, to see stocks move higher. And finally, a further point here is that stocks are somewhat expensive by historical standards, but we don't think that they're so rich that valuations on their own would cause a persistent decline in stocks. And that sums up a quick discussion on stocks and our outlook. The next slide, we can jump into the bond market.
Yeah, I was wondering about bonds because I've been reading about bonds and how they're connected to interest rates, and we're at a very low period of interest rates. They're going to go up. I mean, what's your take on bonds? What's going to happen in the bond market? Should we have them even?
Yeah, bonds are the, you talked about stocks being the engine of a portfolio, and bonds would then be the airbag. Diversified investors own them as an efficient way to offset that volatility of stocks. Our outlook for this category, for this low-risk asset class, is neutral. Rates, on one hand, are very low, but opportunities are emerging in the corporate bond market. That's what we're hearing from our bond managers. The first slide shows monetary policy, and what are we talking about here? It's the tools and tactics of central banks around the world. It's the answer to the question of is the Fed or other central banks, are they pro-growth and trying to create or encourage growth in the economy, or are they worried about inflation and trying to slow the economy down? Right now, we see that central banks around the world are very accommodative, and that trend is positive. What the chart shows is that our Federal Reserve was so pro-growth that it created dollars that didn't exist and amassed a portfolio of bonds over $4 trillion as a way of keeping interest rates low and pushing investors into riskier assets. And central banks around the world continue that practice, which on one side will keep interest rates low, but should continue to support stock and bond prices. So that moves us to the bond yield interest rates. To us, this trend is neutral. On one hand, rates are low, and that will keep our return expectations for the asset class down. But we don't see a lot of pressure for higher interest rates. What will drive interest rates higher is higher growth and higher inflation, neither of which we see as a real pressure for the bond market. So that to us, the bond yields below average is a neutral trend. So bringing it all together, we talked about the economy, we talked about stocks and bonds, and we're neutral across the board. We expect the economy will continue to expand at a slow pace, and in terms of stocks and bonds, today's prices are going to influence tomorrow's returns. Stock prices are elevated, earnings have stalled some, and interest rates are very low. But we still see a compelling case to own that diversified portfolio of stocks and bonds. But our analysis suggests that amid these choppy markets, that we should anticipate moderate returns for the next few years. And when we say moderate, it's below long-term historical averages, those returns that we've come to be accustomed to through some great markets in the 90s and great bond returns over the last 10 years.
Okay, so I'm hearing you talk about the economy, the outlook for stocks, the outlook for bonds. Nothing is spectacular in one way or the other. It's not, you're not saying that we're near the edge of a cliff, although there's always going to be this level of volatility that you keep pointing out, and I can see that happening. And sounds like that volatility is also part of the journey. And I need to keep perspective between a good mix of stocks and bonds and be in tune with the economy. So is that a fair takeaway?
Yeah, I think it is. Yep.
Okay. You know, I get that, but at the end of the day, I feel like we should be doing something. I mean, when you see all this gyration, when you see all these headlines, shouldn't we be changing up the portfolio right now? Jim, I know that you're tuned into this, and I go home at night and I work hard and I see what the headlines are, and I say, boy, we should really take action right now. And so shouldn't we be making adjustments right now?
Nathan, that's the right question. And the good news is we've already made those changes. In fact, we've been making incremental adjustments to our portfolios for a couple of years, preparing slowly for the inevitable, which is this slowdown in the markets. So we have broadened the diversification of the portfolio. We've increased the quality of the underlying holdings, and we've reduced the cost of the overall portfolio.
Okay.
So, yeah, so I think you're looking for examples.
Yes,
and,
please.
Stocks would be one area of the portfolio, and we maintain a diversified mix. And we emphasize domestic stocks over international. So you see that the ratio is a 3-to-1. We have, of all of our stocks in the portfolio, 75% are domestic U.S. stocks and 25% are international. Now, international stocks are more volatile, typically, and the global stock market has a mix that's more 50-50. It's almost half domestic versus international. So this lean toward domestic stocks has stabilized the portfolio, and in recent years has added to our performance as domestic stocks have outperformed. Now, if you look at just the domestic stock portion of our portfolios, we emphasize large company stocks. Now, the ratio there is about 80% in large company stocks and 20% in small and medium-sized stocks. And this is similar to the previous slide, where the small and medium-sized companies tend to be more volatile. And in fact, we're finding in this current year-to-date environment that larger stocks are outperforming. They're not losing as much as the small and medium-sized stocks. Now, if we look at just the large stock portion of our portfolio, we emphasize quality stocks. We've taken 25% of the portion of the portfolio allocated to large company stocks, and we've focused that on the highest quality stocks in the U.S. So those are large companies that have very little debt. They have a lot of cash flow. They're leaders in their industry. They're what you would think of as blue chip companies. And recent research has added to the evidence that these quality stocks over the long haul tend to outperform the broad market. And we tend to see that happen most of all in difficult times in the stock market. What you see here is a comparison going back 15 years. The dark burgundy line is the performance of quality large stocks, and the lighter red line is the S&P 500, the large stock index as a whole. And so they both go up and they both go down, but through this full time period, you see that outperformance coming to bear. So these portions of the portfolio are adding to returns, increasing the diversification, and we've also become to make greater use of new tools to invest as they've come to the market. We're using some of the lowest cost funds available. If you were to look at the average cost of a domestic stock fund, Morningstar records this and reports that the cost is 1.25% per year. Now, our two largest domestic stock fund holdings cost 0.03% and 0.07% respectively, cutting out cost that is not adding to value. So these are some of the pieces and components that are present in the stock portion of the portfolio that we've done to prepare for these challenging markets.
Okay, well, that's good. I like that you're focused on saving me some expenses and managing costs. That's always good news. I want to ask the question I asked earlier before. What about bonds? I still don't feel comfortable with bonds given where the whole interest rate cycle is. And should we still own them? I mean, I'll ask it again. Well, I'm looking for another perspective.
Yeah, it's a common question because of how much coverage there is in the media about bonds. You heard it from Jay that bonds are the airbag to the portfolio while stocks are the engine. And so if we look at history and understand how bonds perform compared to stocks, you see that bonds are often up when stocks are down. On your screen, you see a chart going back to the 1920s. And the burgundy line going down, that's the performance of stocks in a calendar year. And every time the U.S. stock market has been down in a calendar year, you see it on the screen. There are 24 instances. The blue bar represents the performance of bonds in that same calendar year. If you add it up, 22 of those 24 instances that stocks were down, bonds made money. And the two times that they only lost a little bit. So bonds, while they may not be positioned to have above average bond performance, they still remain the most powerful diversifying tool to hold to reduce the risk of an all stock portfolio.
Okay, so that's interesting, but what happens as interest rates go up? Isn't that really going to affect bonds a lot? Aren't they just going to get hammered when interest rates go up?
Yeah, that's a great follow-up question as well, because we hear in the media discussion and article topics and people concerned that there'll be just a slaughter as interest rates rise. But this isn't the first time interest rates have risen. It's not new and different. And we're able to take a look and understand, well, what is the impact? And yes, it is a bit of a headwind, but it isn't the end of the bond world. So we did an analysis, and we projected forward what the one-year return would be if interest rates were to be moved higher by 1%. Now, the Federal Reserve raised interest rates by 0.25% this last time. So a 1% raise all at once would be quite substantial. And if we look at what the long-term bond market would do in an environment like that, yeah, it might lose as much as 11% in that year, all else being equal. But our portfolio has been designed to be much less sensitive to rising interest rates than that. I mean, we would expect our bond mix to lose maybe less than 2%. Well, that's not fun, but that's certainly not being slaughtered. And in fact, when interest rates rise, that means that the bonds will begin to pay a higher yield. And so we can earn that back and be on our way. So yes, it is a headwind. No, we don't expect a rise of interest rates this high all in one fell swoop. but they still maintain their diversification properties, and they help keep risk down.
Okay, that's helpful perspective. I'm actually relieved because all I've been hearing about is how bonds are going to get hammered, but this chart is quite helpful. Now, I remember last year you talking about alternative strategies. Remind me again what they are and how are they doing in the whole mix of investments?
Sure, yeah, so alternative strategies invest in stocks and bonds and alternative assets in just a different way. And we've categorized these strategies into 4 types. And we've gone on to select fund managers for each of these 4 categories of alternative strategies. Now, we do this not because they're better, they're not worse than traditional stocks or bonds. They're just different, and different diversifies. So the way that we've incorporated this other category of investments into the portfolios is we've reduced the amount of stocks slightly, and we've reduced the amount of bonds slightly in each portfolio, and inserted this mix of alternative strategy funds within. So the idea is that we now have 3 baskets into which to diversify your eggs: stocks, bonds, and alternative strategies. So that's the purpose. Now, you ask, how's this going? How's this working? Well, we're pleased and optimistic about the future. Their performance, as designed, is different than stocks and bonds. And to illustrate that, we're going to pick one period over the last year. It was the August 2015 market decline. And let's compare how did traditional stocks and bonds do to our mix of alternative strategies. Now, what you see are 7 different pairs of bars, and each pair represents one of our risk targets. So on the far left would be a conservative portfolio, and on the far right would be an aggressive portfolio. And of course, right in the middle is moderate. And during that August 2015 decline, if you look at the moderate gray bar in the middle, you see that a blend of stocks and bonds lost about 6% during that time frame. Now, our mix of alternative strategies lost about half that, about 3%, during that same period. So sometimes alternative strategies don't lose as much. Sometimes they earn more. Sometimes they earn less. They're just different. And that difference is exactly the diversification we're looking for. Now, we ideally would love to see that difference come to bear in a good way during difficult times for traditional stocks and bonds, and that's what we're seeing here. And in fact, we're seeing that play out again this year in 2016, as on the whole, our alternative strategy funds are faring better than an equivalent blend of traditional stocks and bonds. So we're pleased to have the diversification and expect to see it add value over many years.
Okay, that's good. So, Jim, I'm going to try to see if I understood some key takeaways. You talked about stocks, and you said that you guys have actually been working on shifting some things to emphasize domestic stocks over international stocks in the stock mix here. I heard you say that you're focused more on large-size company stocks, which I know stocks can be volatile, but I know large ones have the chance of a little bit more stability relative to smaller stocks. And I heard you talk about quality stocks, like these are good, probably brand name companies that I'm familiar with. I heard you talk about some managing of expenses, looking for low-cost investments, and I really like that. Heard you talk about bonds and that they're still important to be a part of a diversified portfolio, and it sounds like you guys have done some things to try to minimize some of the potential volatility in bonds by focusing on maybe different types of bonds than what I'm reading about in the newspaper and here on TV. And you're still in the alternatives, that it's another mix of diversification, and last year they helped and they're doing their thing. Is that a fair takeaway?
A great summary, yes.
Okay, good. Well, I want to switch gears and move over to talk about financial planning. And Christy and Nicole, I have questions for you. I get that it wasn't a great year in the markets last year. I get that the outlook's not great. I'm still a little discouraged. I mean, I've been working hard, I've been saving, and I heard what Jay and Bill and Jim said. That's good, but am I still on track? Am I going to be able to retire? And should we be doing something more than what the guys already talked about? How about you ladies? Give me some good clarity here. Let the let the ladies lead the way, please.
Hi, Nathan. This is Christy. Our financial planning process is designed to answer those questions that you just talked about. Are you on track, and are there any changes to be made? So it's time for you to do an update to your plan. Let me share with you what that process is and why we do what we do. The first step is for us to provide to you an information request package. This will give you a chance to reflect on any changes that have happened, reflect on if there's any family commitments that are going to impact your plan, really take into account the changes to your personal economy. And once we take a look at all the information and changes in your life, we'll go back through the plan and look at all the areas of planning and provide you a monitoring report. If we look at the next slide, what this monitoring report will do is provide a look of what happened in the past versus where you're at today, review all the areas, and determine if there's areas that need action or if there's areas that you have a green light on and no action needs to be made, but to give you peace of mind that you're doing everything you can in those certain areas.
Okay. Well, that's a good reminder that I need a plan. I need a roadmap. I need to update that, and that's very helpful perspective. But at the end of the day, I still feel like I'm at the mercy of the stock market. I can do all these things, organize these things, but then the markets do what they do, and I'm not sure if my investments are going to be able to help me get to my goals. Is there any other perspective that I should be thinking about? Help me understand that.
You're right, Nathan. You can't control the markets. But what you can control are your own actions as they relate to a well-thought-out financial plan. Now, you just identified some of the intangible benefits of planning. Things like providing confidence and clarity, helping you sleep better at night. But what I'd like to introduce to you today is a concept that we call planning return. And what it is a real and tangible way to quantify how making smart financial planning decisions adds to your overall return. So if you take a look at the next slide here, these words represent just a few of many, many financial planning strategies. By utilizing some of these strategies, you could add as much as 1, 2, 3% or more to your overall return. That is certainly significant.
Okay. Well, that caught my attention. What are some examples of how I can add to my personal return through the planning you're talking about?
Nathan, let's just take a look at just one of those strategies so we can quantify it for you. Let's look at account withdrawal order. Now, let me explain what this is. If you think about it, over the course of your working years, you've accumulated money in IRAs, Roth IRAs, and taxable accounts. And when looking at this, a smart withdrawal order accounts for the different taxation of each of these accounts. So to review, an IRA is going to be fully taxed at ordinary income. A Roth IRA is not taxed. All that money to you will be tax-free. And then your taxable account, well, that will vary, but you'll experience some taxation. So the question becomes, which accounts do I take withdrawals from and when? And I want to reference a study by Vanguard. And what Vanguard has looked at is, if we look at the next slide, not having a plan or a strategy of which accounts to take from and when, you're not going to get any additional planning return. But having a strategy that takes into account the taxation of those accounts each year is significant. So if we look at 20 years, over the next 20 years, Vanguard is saying that it will equate to about a 0.7% planning return. And you might think, well, that seems insignificant. But on $1 million portfolio over 20 years at a 0.7% increase in return, that's going to equate to an additional $350,000 to your pocket, which we would call planning return.
Okay, well, that gets my attention. I'm all for saving taxes. I'm getting all these tax documents in the mail, and that's another mailbox moment for me when I get ready to do the return. So that's helpful to see that there needs to be, I'm hearing you say, thoughtfulness in the withdrawal plan. Now, what's another example besides this withdrawal thing?
Hi, Nathan. It's Nicole again. And Christy just spoke about the account withdrawal order. But the next step is when to actually take distributions from your investment accounts. Some people take distributions when they need the money. Other more organized folks take distributions on a monthly systematic basis. But over a long time period, these strategies really aren't that efficient because they force investors to sell investments when they're low to take care of their living expenses. And we know that's bad. At Planning Alternatives, we have a unique cash distribution strategy that adds to your overall plan return, and it has 2 steps. So the first step is to create the distribution reserve account. And this is this light blue section that you see at the bottom of the graph here. And what this account is it's an account that's composed of cash and very low volatility investments. This is where you actually take distributions from to fund your living expenses. However, you realize that over time, that cash is going to deplete, and we're going to have to refill that distribution reserve account. So what we do is, as we look at market conditions, we refill the bucket when markets are high. So what this does is it allows us to sell high at these sort of green circled areas on the graph to refill your distribution bucket. It's sort of like skimming the cream off the top. In fact, Morningstar concludes that utilizing a smart cash distribution strategy like ours can add another 0.7% of planning return. That's an extra $350,000 on a $1 million portfolio over 20 years. And that's in addition to the planning return that Christy just identified.
See, I knew you ladies would get it. This is great perspective. This does remind me, though, of another item that I've been reading a lot about, and it's things that are going on with Social Security. And I know there's a lot of options with Social Security, and I don't really understand all those options, but I know that you guys do. So what's the whole insight around Social Security strategies that might be a good takeaway for me?
Sure, Nathan. There is, as you said, multiple strategies for claiming Social Security. The best strategy depends on a number of variables. And it would depend if you're married, and we're looking at a married couple and the age difference between the spouses. We're looking at other incomes. We're looking at health and longevity in terms of how long we think you're going to live. But when we take into account all of those different variables and step back and assess what's best for you, what we find is the planning return can be significant. And it could equate to several hundred of thousands of dollars over the course of a retiree's lifetime. And even though that, again, seems kind of like, okay, well, what does that really equate to? On average, that would put, let's say, $10,000 additional in your pocket if I look back at the plan we did last year. So all of these variables need to be taken into account, and it's easy to assess in this area what your planning return would be.
Okay. So I think I get this. There's investment return, and then there's planning return, and there's a lot going on with the investments that we had talked about at the front end of this discussion. But I'm hearing you talk about some probably fairly common planning strategies that can probably add a couple percent to my bottom line. Is that, which is really incredible if you think about it, is that what I'm supposed to have as a key takeaway here?
Absolutely, and we've only highlighted just 3 of them. There's a multitude of strategies to look at and to review where there could be some planning opportunity or planning return opportunity for you. And if we look at this, what planning does is it allows you to control what you can to offset what you can't, like the markets, as Jay had said earlier. And so when we're looking at the financial planning process, financial planning is about 3 things. The first is to assess the likelihood of you achieving the goals that you've set out for yourself. 2 is identifying and implementing all these planning strategies to increase your planning return. And when we do this, we also increase the likelihood of you achieving your goals. And then the third step of the planning process, and the important part, is to assess this on a regular basis and refresh the plan every 1 to 2 years, because as you had said before, things change, and we need to stay on top of those changes.
Okay. I get that. That was very helpful. So I'm hearing you say that you're going to send me an updated information request packet, and that will help me update the plan that I did last year. Is that the next step for me?
Absolutely.
Okay, good. All right, audience, that was the core of our presentation. I'm now going to switch over from client. Hopefully those were good questions and questions that were on your mind. I'm going to switch over to moderator again and cover some Q&A. We've had a number of questions that have been submitted, and we'll take some time here to go through a brief discussion of some key questions. First one, Jay, is I'm going to send your way around interest rates. And the question is, what is your sense of what interest rates might do this year? Are they getting ready to skyrocket? Are they going to be flat for a long period of time? What's your perspective on, I guess, how quickly or not interest rates will change?
Hi, Nathan. Jason. Well, fortunately, I have the benefit of my Bloomberg terminal open, and I can answer what the market is pricing in for probability of rate hikes. All the way out to December of this year, we're looking at about a 40% probability of a move by December. So, I mean, that's a very detailed way of saying the market isn't pricing in, odds of short-term interest rates moving higher. And as I mentioned before, the 2 components that really drive longer-term interest rates are inflation and economic growth. And unless we see some real pressure on inflation and stronger economic growth figures, I wouldn't anticipate seeing interest rates move much higher. Obviously, longer-term rates will trade in a range, and as the stock market improves and fear abates a little bit, you'll see yields tick higher. But we're not anticipating yields moving substantially higher. So, in the 2, to see something above, 2.5% on a 10-year Treasury would be, I think, a surprise.
Okay. I'm going to switch over to a financial planning question headed your way, Nicole. And the question relates to trust titling. So one of the words or phrases that were on the screen was trust titling. What is trust titling, and why is it important? And how do you do it? What's a quick overview of trust titling?
Sure. That's a great question, Nathan. Part of financial planning is making sure that all of the assets that you own are owned by the correct person or legal instrument. So having a trust is a great way to transfer assets to the next generation. And where the planning return can come into place is by having all of the asset titling done properly and working with your attorney and financial advisor, making sure that that's done can potentially eliminate a lot of very expensive probate costs on the back end if there's any confusion regarding any outstanding assets or purely the time and expenses of going through the court process.
And where do you see some mistakes in the trust or trust titling process from your experience, either in the document or in the whole process? Like how do you change a asset to get the trust connected to it?
So many folks, Nathan, will work with a great attorney and create estate planning documents, including trusts, and then they think they're done. When in fact, one of the most important steps is making sure that the trust gets appropriately funded. And what that means is updating ownership of the appropriate assets to be put in the trust's name. So for example, with your investment accounts, that's something that we can very easily, with just a little bit of paperwork, accomplish for you at Planning Alternatives.
Okay, got it. Bill, a question for you around diversification and the quilt chart. So you showed how the different asset classes moved up and down. How is it working out so far this year? Is it doing what you would expect, I guess, is the question with the diversification of mixing things together?
Hi, Nathan. Yes, that's exactly been the experience. When you look at the combination of bonds in the portfolio, they have actually performed that ballast responsibility for the portfolio in making sure that your account doesn't have the full effect of the drawdown, of the stock market.
Okay. And from a projection, or actually this is for you, Jay, talking about 2016 and beyond with the economy, just want to re-clarify that this is you're neutral. So that means you're not seeing, you're seeing things more middle of the road. Is that a fair takeaway with your expectations of the economy?
Yeah, I think the fact that we are that we're later in the cycle. This is not, and in a period of time, frankly, where post-financial crisis recessions are not typically an environment where you see robust economic growth. It's an environment where the economy is really saddled with a lot of debt. Typically, it moves from the private sector to the public sector, as we saw. And economic growth is low, and that's the environment, and that's why we give it an outlook of neutral, is because it's not because we expect growth to decline and turn to a recession. It's just that this type of an environment, especially since we're closer to mid or late cycle, we're seeing low growth, and we have a lot of good years in the rearview mirror. That's basically why we see that reading of neutral, that low growth into the future.
Okay. One more question for you, Christy, and it's around Social Security. You were talking about Social Security strategies and how it's important to evaluate them. There's been some recent change, though, in Social Security. Can you quickly give an overview of that?
Sure. One of the claiming strategies is going away April 29th of this year. And let me explain what that strategy is, because there's a window for those that are still eligible for it that should consider taking advantage of it. It's called the File and Suspend Restricted Application Strategy. What this involves is, think of a married couple, and they both have their own work records. So they each have their own Social Security benefits. The one spouse would file and then suspend his benefits, let's say him, till age 70. That filing will allow the wife to go in and claim spousal benefits and receive half of his benefit, while letting her own benefit accumulate till age 70. What ends up happening is you have two benefits that are being elected at age 70, but in the meantime, there's a spousal benefit being collected. This has a great opportunity for some planning return, as we had talked about. Unfortunately, the strategy is going away April 29th. For those who are age 65 or older, who turned age 65 and a half by October 29th of last year, this is a strategy to consider to file and then suspend your benefit until 70. For those who are eligible for a spousal benefit, or would be taking a spousal benefit, those who have turned age 62 by last year would be eligible. So if you fall in that category of ages or older than 62, that's something to call us on to make sure that you're taking advantage of that planning return opportunity before April 29th.
Okay, now there's a lot of changes that seem to take place, and it's hard to keep up with them. Final question, and this is for you, Jim. What would be an example or two of a quality stock? You talked about how that's an emphasis within that large company category you described.
Yeah, sure. What's easy about answering this question is think of the biggest company that you know, name brand household companies, and many of those fit the definition. A big one comes to mind is Coca-Cola, giant company, dominant in its industry, certainly fits our metrics for what a high-quality company is. And if you look at it year to date, it has a positive return, unlike the stock market. Another would be, think Walmart, obviously a huge company. They're up 7 or 8% this year, which is maybe not what you'd expect. Some of them aren't household names that you necessarily might talk about, but they make tons of products in your house, like take 3M, another quality company with a positive return year to date. I have some Scotch tape, I think. Don't they make Scotch tape? It's right here on my piece of paper. So these big companies with lots of cash flow, household names, blue chips. Those are a few examples.
Okay, great. Well, I want to thank everyone for attending. This concludes the core content of our webinar. We appreciate you investing the time. We look forward to seeing you and sitting down or discussing over the phone how all of these issues, the content that was presented today, directly applies to you. And that's our job, is to meet with you and discuss things so that you have clarity and confidence that all the things that are going on in the world, we're helping you navigate them, and that you're focusing on the things that you can control, which are really around the planning strategies and the reviews and the goals and discussions that we have there. And even though we're in an environment that we don't have direct control over, we want to navigate that environment by focusing on the things that we can control. We offer a number of educational workshops, whether it's webinars, which are intended schedules to provide a quarterly webinar on a relevant topic. So we always enjoy presenting these concepts and educational material to you. We also have other initiatives around one called Planning Alternatives for Women, which is a specific educational workshop to help women get empowered with different financial concepts and strategies. So look for that information in the mail. And we also want to ask for your help and pass on the information to others that you know about us. We're open to take on new clients and look forward to helping people at all stages of life figure out how to make great decisions with their money so that they can have a clear path toward what's important to them and have a lot of peace of mind in the process. So any additional comments, feel free to share those via survey, which you will get about an hour after this meeting. And also we want to remind you that our website is another resource. We have recently posted 2 articles, one from Jason Close and one from Marilyn Dimitrov, giving some current perspective about the markets and just what's been going on so far and what to expect going forward. So once again,